Okay, now we start session number 3 before we close for the day. This session involves preparing for the global minimum tax challenges for businesses and tax practitioners. Just a small gist before we start the session. In July 2023, around 138 inclusive framework members vouched their commitments to the two-pillar solution. As of the present date, the global minimum tax under Pillar 2 has already become a reality, with over 50 of them taking steps towards its implementation. Issues include practical challenges in transposing the model rules into the domestic law, the impact of the new rules on domestic tax and foreign investment. Session 3, our last session for day 1, shall deal with the effectiveness of GLOBE rules. I now call on the chair, Rebecca Rose, the member of the IBFD Board of Trustees, to come to the mic podium. Thank you.
Distinguished FIT IBFD hosts, colleagues, guests, and delegates, I am very honored and very pleased to chair this next session on preparing for the global minimum tax. We know from the conference materials how this has been progressing in the last year, and our session is about how should we understand Pillar 2? What are its fundamentals? How does it interact with traditional tax infrastructure, tax treaties, incentives, anti-avoidance, and more? And what challenges and opportunities does it bring for capability building, for training up businesses? What are the implementation next steps? What comes next? In the next hour and a half or so, we're going to cover these topics. We'd like our session to be as interactive as possible, so we will be coming to you from time to time and asking for your questions and also for your feedback. The representatives on our session are as strong and as diverse as the topics themselves. They truly represent together an all-stakeholder view. Over the last weeks, I've had the opportunity and pleasure to observe and collaborate with them as they've been expertly putting together their sessions. I know how focused and how keen they are to share their knowledge with you, and I hope that you will join me in looking forward to the session. Please allow me to introduce, in turn, Rachel Shaw. She heads the IBFD Asia Pacific Knowledge Group and is chair of IFA Malaysia. She will be giving us an overview. Then we have Professor Dr. Vikram Chanad, Professor of International Tax and Tax Policy at University of Lausanne. He will be leading the panel discussion. We have Professor Yvette Lind, Professor of Law from the Department of Law and Governance at the Norwegian Business School. Dr. Amar Mehta, International Tax Expert and Advisor and Commentator and Author on Tax Matters. Chetan Rao, Commissioner of Income Tax, Foreign Tax and Tax Research, Department of Revenue, Government of India, and Dr. Akram Protz, Deputy Director, OECD, Center for Tax Policy and Administration. Again, it is an honor and a pleasure to hand over to our panel. Thank you very much.
Thank you, Rebecca, and my thanks to the organizers for having me here in person to share with you an overview of the critical developments in terms of the GLOBE proposal, more commonly known as Pillar 2 or the Global Minimum Tax. So what is Pillar 2? Pillar 2 introduces a new taxing mechanism whereby MNEs with a global turnover of more than 750 million euros must pay a minimum effective tax rate of at least 15% in every jurisdiction in which they operate. The ETR is simply a ratio of the MNE's taxes due in that jurisdiction divided by the MNE's global income from that country. Of course, I use the word simply, but it isn't as straightforward as just taking numbers from your P&L and plonking it in. Otherwise, I think quite a few of us would have to update our resumes. Key adjustments have to be made as the covered taxes include actual domestic corporate income taxes, withholding taxes on income payments received, and CFC taxes. Now, why do we have this? Well, the intention is to try and ensure that MNEs pay their fair share of taxes, while at the same time making it more difficult to shift profits to lower tax jurisdictions. and also putting the brakes a little on the race to the bottom, where jurisdictions compete to attract MNEs by reducing their tax rates. Who does this apply to? Well, it applies, like I said earlier, to MNEs and their constituent entities with annual gross revenues of 750 million euros and above in the consolidated financial statements of the ultimate parent entity at 750 million euros for now. With regards to jurisdictions, the OECD model rules are not mandatory. Inclusive framework jurisdictions are not required to implement them. However, if they do so, they must adopt a common approach prescribed, and where they do not, they must respect the application of the rules applied by other jurisdictions. Now we contrast this directly with the EU directive, which is mandatory and requires all member states to enact. So how is this done? This is done via a series of interlocking measures comprising an income inclusion rule, IIR, an under-taxed profits rule, UTPR, and the qualified domestic minimum top-up tax, QDMTT. Years ago, I did a presentation on emerging global trends, and I included in there like the skyrocketing use of acronyms and abbreviations. I should have put money on that because I can see that being put into full use right now. The origins of Pillar 2 date back to the BEPS Action Plan, which was in 2013, where we saw 15 BEPS actions emerge. And there was a lot of work that was done and a raft of reforms that came out from these BEPS action plans. However, the difficulties that were posed by digitalization were considered to be particularly challenging, and work on these issues continued, which brought about the dynamic duo of Pillar 1 and Pillar 2. Particularly, as you can see, in the past 3 years, there has been a lot of development with regard to Pillar 2, or the global minimum tax. In order to bring you this, the OECD has had numerous public consultations and published thousands of pages. I only have 10 slides. So please note, this isn't P2 in a nutshell. This is the Mahabharata in a page, essentially. So while substantive agreement by the inclusive framework members on the scope and detail of Pillar 1 has yet to be reached, Pillar 2 is now well on the way towards implementation. Shameless plug here, my info is based on our newly launched Global Minimum Tax Monitor, and we can see from that 146 countries have committed. 33 countries are in the work in progress stage, and by work in progress, we mean that draft legislation has been issued, details have been done, public consultations are being carried out. And we see that 4 jurisdictions have implemented some of these rules, and the EU being the 5th via its directive. So a little bit more about the GLOBE rules. We will have to become very familiar with this over the next few months if you haven't already. The primary mechanism for collecting top-up tax is the IIR. And the starting point is that the top-up tax will be paid by the ultimate parent entity. The income inclusion rule is effectively a backstop rule. It allows the residence country of the ultimate parent entity to impose a top-up tax where any constituent entity of the MNE is subject to a low effective tax rate at source, i.e. less than 15%. The UTPR, in turn, acts as a backstop to that and would apply when an in-scope MNE does not pay at least 15% ETR, and a top-up tax is also not paid under the income inclusion rule in another jurisdiction. Please bear in mind that the UTPR has considerable flexibility in the form that it can take. In fact, there is no need for a payment or a tax. It could actually be effected either by denying deductions or imposing a separate charge. The QDMTT. The QDMTT is like your reverse UNO card that you have. Essentially, adopting the QDMTT means that instead of the top-up tax being paid at the level of the ultimate parent entity, it is the source country that imposes and collects. Therefore, the tax essentially or effectively will be paid where the income is earned. Tax paid by an entity under the QDMTT is fully creditable against the entity's global liability. In effect, it will take priority over any top-up tax imposed under the GLOBE rules, and the result is that a jurisdiction with a QDMTT will be the first to receive any top-up tax from entities within that jurisdiction. We have seen quite a few countries, especially developing countries, being very open to adopting the QDMTT. Of course, there are some countries which have said that they are still contemplating on this, which you might think a bit strange because given the fact that there is a shifting of the taxes back to the source country as to why a country may not be willing to take up the QDMTT. And it really has to do with the individual status of that country and their economy. Some countries are very small. They may not have a lot of these MNEs operating in them. And so they find that there is no need to take up the QDMTT because essentially they're not going to get much out of it. Or they may have just one or two, and the capacity and the resources required to implement the QDMTT may not actually outweigh, may actually outweigh the revenue that is gotten in return. Hang on a second, my slides have disappeared. I'll move on to the STTR, the subject to tax rule. Now, the subject to tax rule is essentially a source-based rule that allows a source jurisdiction to impose a withholding tax or deny tax treaty benefits on certain cross-border payments, such as interest, royalties, or fees, if the payment is subject to an ETR below the minimum threshold in the recipient jurisdiction. It is meant to address situations when the IRR and UTPR do not apply, such as when the payer and the recipient are not part of the same group, or when the payment is made to a jurisdiction that has not enacted the Pillar 2 framework. This is of particular interest, therefore, for countries which have withholding tax rates of less than the agreed minimum rate of 9%. Please note that the STTR, even though they're together on my slides, is not actually part of the GloBE rules, which comprise of the IRR and the UTPR and the QDMTT. It is, however, a complementary part of the Pillar 2 package and is used to boost the rules itself. So as you can see, Pillar 2 and GMT is quite a complex mechanism with a lot of interlocking parts and backstop measures that come into play. It requires a keen understanding of what is going on and also an ability to keep up with all the changes that happen and may not easily transpose or transfer down the ranks. So there is considerable room for mismatches, misunderstandings, and perhaps even missteps. In order to deal with this, or I should say, all hope is not lost because there are some efforts that have been done to address these issues. And we do see that safe harbors have been introduced. In 2022, there were 3 published reliefs, which were the transitional CBCR safe harbor, the transitional penalty relief regime, and the simplified calculation safe harbors. The first 2 being temporary, while the simplified calculations are permanent. In July this year, the OECD issued its second set of administrative guidance and included in their QDMTT safe harbor and a transitional UTPR safe harbor. Now, the safe harbors only represent a significant simplification of calculation and compliance. It does not exempt you from complying with the group-wide GloBE requirements, such as the requirement to prepare and file its GloBE information return. And of course, like all safe harbors, they are subject to quite specific requirements. So one of the key questions that comes up with this is how will disputes be resolved? As I mentioned earlier, there's plenty of room for misunderstandings and mismatches, so we can almost be assured that there will be some, if not a significant amount of dispute, and therefore dispute resolution factors very keenly. Well, the Pillar 2 framework has been geared towards trying to prevent as much dispute as you can or trying to nip it in the bud. We see that there will be peer reviews across jurisdictions to ensure that there is some sort of unity or conformity in implementation. There will be coordinated compliance, and we understand it will be similar to the ICAP, and that there is continuing guidance being issued. But there undoubtedly remains an issue which needs to be addressed. And if we look at what we have right now, in the absence of an overarching multilateral option, the resolution of disputes fall back on double tax treaties, including the mutual agreement procedure. However, MAP provisions generally allow taxpayers to initiate MAP proceedings only where it is claimed that the actions result in taxation not in accordance with the relevant tax treaty. So it is not certain that the disputes concerning the GloBE rules will be able to apply MAP. In some double tax treaties, provision is also made for authorities to consult on elimination of double taxation. However, under the GloBE rules and with the adjustment of taxing rights, it may not be a case of double taxation. It may be a case of higher taxation than what is actually meant to be. And in which case, then there may not be able to apply the treaty dispute resolutions because it does not fit within the definition exactly. Therefore, to rely on existing double tax treaty dispute procedures alone is unlikely to be a complete solution. In light of this, though, thought is being given as to what alternative dispute resolution mechanisms may exist, one option being actively considered is a new multilateral convention, but I think this is something that is on the cards and to be seen in future. And finally, we can't talk about Pillar 2 or global minimum tax in Asia without talking about incentives and how reliefs are treated. We have seen in the region that countries are now taking steps to redesign their tax incentive schemes. We have seen a significant number of tax incentives being grandfathered. We have seen competition for non-tax incentives. If you would like, the earlier session this morning talked about digital nomads. The opening up of immigration borders or the lightening of immigration rules for digital nomads is seen as a way to improve the competitiveness of a country, attracting talent that can move in and out quite easily to deliver what they need. We've got the SBIE, and of course the question there is whether or not the substance-based income exemption will actually provide enough carve-outs for taxpayers. MNEs point out that, this SBIE takes off my top-up tax, it doesn't actually reduce anything else. So, and then it's also a proportionate reduction. So for MNEs or taxpayers who have had the luxury of having tax incentives all this time, significant work needs to be done here. I won't go into it too much because I know this is a panel session, but this is my last slide. So with that, I'll just point out one thing, that what has happened in Malaysia, a country known for its 1001 tax incentives, has seen the sort of rationalization whereby tax incentives are now being brought back under one central administration as opposed to what it was before. So there is some good news from this. And with that, I leave you with this, and thank you all for your time. I also have to invite Vikram up here to handle the panel session, where they will go very much into depth.
Yes, so thank you, Rachel, for that opening presentation, and where you basically set the scene and you spoke about how the GloBE rules apply in general. So we are going to get into a panel discussion right now, and the topics that we are going to address are basically in relation to the compatibility of this Pillar 2 framework with tax treaties. We spoke about tax treaties in the first and the second session. We will touch upon this topic once again. After that, we'll also discuss a lot about tax incentives, the last slide which Rachel had on her presentation. We are also going to touch upon the question of whether or not still need anti-avoidance rules in the existing system, given the fact that Pillar 2 is going to be the new reality in a lot of countries. We'll also touch upon capacity building concerns associated with Pillar 2. And finally, Akim will give a presentation, and he will talk to us about the future direction of Pillar 2, or what we can expect probably for Christmas, right?
Absolutely.
So he's going to give us some Christmas gifts. Let's see. So the first topic that we're going to address right now is the compatibility of the Pillar 2 framework with tax treaties. Tax treaties is a hot topic here. It was discussed in the first panel and the second panel too. So we'll touch upon this issue once again. And to give this presentation, it's actually me. I'm giving a presentation. So I'm the first panelist, and I'm going to speak about interaction of the Pillar 2 rules with tax treaties. So Rachel actually explained there is a particular sequence how the Pillar 2 rules apply. You start with the QDMTT rules, then you move to the IIR, and finally, then you move to the UTPR. Now, the question is whether any of these rules, which will be implemented in national tax law, so all these rules are going to come in national tax law of all the adopting jurisdictions. The question is, do these rules breach tax treaties, or is there any kind of friction between these national rules and tax treaties? So if you could just go to the next slide, please. I think I should do it myself. So just to give you a very simple example here, in terms of an example, just assume the situation where you have a foreign UPE, and which is in the country R, and it has a constitute entity in country S. The constitute entity could be a permanent establishment, it could be a branch, or it could be a separate legal enterprise. Now, assume that country S, what they do basically is they adopt a QDMTT, and they collect top-up taxes at source. But the way the legislation, the domestic legislation is designed, is that it applies only to foreign in-scope headquartered MNEs. It does not apply to domestic headquartered MNEs. It applies only to foreign MNEs, or subs or constitute entities of foreign MNEs. So the question there is whether this domestic legislation which a country introduces, pursuant to which they basically target only constitute entities of foreign-owned enterprises, or foreign headquartered or foreign UPEs. The question is there any discrimination under the standard tax treaty rules under Article 24.3, which deals with the P non-discrimination clause, as we all know, or Article 24.5, which deals with the ownership non-discrimination clause? Well, if a country is just applying a QDMTT only to subsidiaries or permanent establishments or foreign MNEs, then of course there is a discrimination concern. And the way that discrimination concern can be addressed is in a very simple way. The very simple answer to this question is, how do we address this discrimination concern? Well, the answer is very simple there. You just have to ensure that the Pillar 2 rules apply to both domestic headquartered MNE groups as well as foreign headquartered MNE groups. So if they apply to both foreign and domestic headquartered MNE groups, constitute entities of these MNE groups, then discrimination concerns go away. So that's with respect to QDMTTs. But then moving on to something a bit more interesting, it's on the interaction of the domestic IIR rules or domestic UTPR rules with tax treaties. Just to give you a very simple example here, suppose you have a UPE once again in country R, and the UPE has a subsidiary in country S or a PE in country S. Actually, that's the PE of the UPE. So I don't know what happened to the direction of the arrow. The arrow just changed by itself magically. So you have a UPE with a PE. So typically, if the subco 1 or the PE, they are exposed to an effective tax rate of less than 15%, then the UPE can collect the top-up tax pursuant through this income inclusion rule. Now, if the UPE does not collect the top-up tax pursuant through this income inclusion rule, then the subco 2 can collect, or the country where subco 2 is, state S1, it can actually collect the top-up tax through this under-tax profit rule. Now, the question here is whether any of these rules, for example, the income inclusion rule or the under-tax profit rule, they conflict with the treaty provisions. So, possibly yes, possibly no. So there are arguments here for conflicts and arguments against conflicts. Now, if I just go into the arguments for and against, then you're going to be sitting here for the rest of the day. I don't want to do that. But what I'll just tell you, what are the potential friction areas? The potential friction areas are possibly with Article 9.1. Now, there's a lot of discussion and debate. This is something which we wrote in a journal. It was published in the World Tax Journal of the IBFD, where we came up with a unique concept, me and some other co-authors, that these Pillar 2 rules, I mean the IIR and the UTPR, they could possibly breach Article 9.1 because they go beyond an arm's length, because they reallocate profits, which somehow, so just to take a step back, so Article 9 basically says, Article 9 deals with allocation of profits among associated enterprises, as we all know. So what does the IIR do is, once an arm's length profit allocation has been made among associated enterprises, the IIR rule applies, and then they basically reallocate profits back to the state of the UPE and impose a top-up tax on those particular profits. So possibly there's a friction with Article 9.1. At the same time, in literature, you find a lot of courts, they have basically held that CFC rules, the regular CFC rules, they basically conflict with tax treaties. There are a few court judgments, let's say around 3 or 4 to my knowledge, but majority of the judgments, they say that CFC rules don't conflict with tax treaties. But still, you could possibly argue that the income inclusion rule conflicts with, or Article 7.1 somehow restricts the application of the income inclusion rule. Similarly, there's another specific provision which you find in the article that deals with dividends, which is Article 10.5, deals with taxation of undistributed profits. Possibly, you could say that this rule could also prevent a state from applying the income inclusion rule or the undertaxed profit rule. Similarly, you have the rules which deal with the elimination of double taxation, and I think there's a big conflict possibility here where, for example, you have the country of the UPE. The country of the UPE is basically exempting the profits which are attributable to a foreign PE, and now suddenly the country of the UPE, they apply an IR and they say, okay, we're going to tax the profits of the PE, even though under the tax treaty you follow the exemption method. So possibly there's a friction area there. And similarly with certain tax-sparing clauses. Because under tax-sparing clauses too, the country of residence of the enterprise, it typically says that, okay, we are not going to tax the profits which have not been subject to tax in another country, so we will apply some tax-sparing clauses and give some credits, or we apply the exemption method on deemed taxes, for example. So once you have the IR, then suddenly you're trying to tax possibly situations, you're possibly trying to levy taxes in situations where the tax-sparing clause would apply and actually tell a state not to tax. Pillar 2 rules now ask the country to collect that tax. So there could be some conflicts with certain tax-sparing clauses. Less about IR, I think one of the biggest areas where you see a lot of academic debates is in relation to the compatibility of the undertaxed profit rule with tax treaties. And there, several articles have been published in various journals where a lot of academics, including me, actually, we've argued that the UTPR actually conflicts with tax treaties too. One question which still arises is that assuming so many conflicts exist, can somehow, there's another rule in tax treaties, it's Article 9, it's the saving clause. Can somehow the saving clause help countries or save countries from these potential conflicts? Well, the saving clause can actually help them in certain situations, but there are certain situations where the saving clause cannot really come to the aid of a country which is implementing the Pillar 2 rules, for example, especially when you're dealing with permanent establishments. Because if you can also apply the UTPR to permanent establishments, and permanent establishments are not like residents, because the saving clause permits a country to tax its own residents the way it wants to do. But if you're dealing with permanent establishments, the saving clause does not really apply to permanent establishments. So the bottom line here is that there are a lot of potential friction areas between the GloBE rules, the QDM, let's say the IR and UTPR, less with the QDMTT, with the IR and UTPR. There are possibilities that conflicts do arise. And the question is, okay, fine, if a country still goes ahead and implements these rules, then perhaps we can also argue that these are tax treaty overrides. So these rules, IR and UTPR rules, they are overriding treaty provisions. So if they override treaty provisions, basically then the question is, how do we solve this treaty overrides? Can we invoke the mutual agreement procedure? Well, as long as the issue is a tax treaty issue, Article 25.1 basically says, yes, you can, as long as the issue is a tax treaty related issue, you can apply the mutual agreement procedure and then you can solve this particular problem. But for tax treaty overrides, how many tax, I just think that's not a very logical route to go through. Possibly because it's a tax treaty override, there could also be some conflicts with bilateral investment treaties, which is another topic altogether. So the proposal here is, how do you ensure that conflicts do not arise? Well, if a country wants to ensure that conflicts do not arise, possibly they can introduce something known as the safeguard clause in the tax treaties. So you agree in the tax treaties that the country can basically apply the Pillar 2 rules without creating any frictions with tax treaties. Now, the question is, how can such a clause be inserted into tax treaties? If you go through the bilateral route, it's going to take ages. It's not a practical thing to do. So a multilateral convention needs to be opened up, and possibly this issue has to be tackled through a multilateral convention. which is also possibly being contemplated in the context of dispute resolution, not immediately, but once the GLOBE returns are filed. Possibly all these Pillar 2 disputes, which Rachel spoke about, also could be solved through a multilateral convention. That could be a possible route. Now, once again, I just want to tell you that everyone has difference of views on this particular topic, whether the GLOBE rules conflict with tax treaties or not. I just gave you my personal view. I'm sure the panelists all may not agree with me, which is fine, which is absolutely fine. And it's good that we can have a debate on this rule. So I'll just stop here. And given my role now as a panel chair, I will ask anyone if you would like to comment on this at this point in time. Later. Okay, Chetan, we'll go to the topic later. So that was the first presentation with respect to this panel. We're going to move to another topic, and the topic is a very sensitive topic, especially for developing countries. It's on tax incentives. And to discuss this topic, we're going to have a few opening remarks by Professor Yvette Lind. So the floor is yours.
So I am fairly famous in the European conferences to not be a long speaker. So I will try to recuperate some time we lost in the start. First of all, I wish to express thanks to the organizers for being invited here. This is a very topical, obviously, and very important conference. And I'm very excited and happy to be here and get to know the FIT community better. So I will try to talk to more of you during the breaks. With that being said, while Pillar 2 sets the bottom floor for corporate tax rates, albeit with some restrictions, as Rachel guided us through initially, there are still opportunities for tax competition. And tax incentives are most definitely one of the avenues discussed for such tax competition, hence the sensitivity. Both developing and developed countries will need to consider how to evaluate and revise present tax incentive regimes, as well as consider in what ways they can introduce new tax incentives as a way of keeping up the international tax competition. So as we know, tax incentives make out important fiscal policy tools and are frequently applied in both developing and developed economies alike. We can, and I would like to stress, should most certainly discuss the efficiency or inefficiency of these tax incentives when employed for international tax competition, or just in general, to be honest. By efficiency, I speak of economic efficiency, in other words, their cost efficiency, and whether it would make better economic sense for state in question to merely use cash subsidies and paying it directly to the companies or the industries instead of using tax incentives. Political efficiency, in other words, to what extent the tax incentive actually manages to fulfill the underpinning tax policy. And legal efficiency, in other words, to what extent is the tax incentive efficient when considering the implementation, application, and interpretation of it. Now, the efficiency of tax incentives is often brought into question, and rightfully so, as these tax measures actually subsidize a selection of undertakings through the use of public funds. This should be underlined, tax incentives are not free lunches. And as such, countries, lawmakers, and all involved stakeholders should be looking at this critically if that is the best solution for the problem at hand. But given the time frame for today, we leave the discussion to the side, even if I'd like to stress that I would like to see more attention brought to these discussions, because we often critique, as you say, the efficiency of these tax incentives, but we rarely actually have some more concrete evidence for when it actually works or when it works less well. So what is of relevance to the audience for this panel is that the OECD, as I'm sure Dr. Plus will bring up later, has attempted to underline the inefficiency of tax incentives when used for international tax competition, mainly then by developing countries. The role of tax incentives in matters of harmful tax competition. In addition to providing us with the discourse where source countries, mainly these developing countries, have been forced by MNEs to extend such tax incentives. As such, the BEPS project attempts to save them from this predicament. There are differing opinions of this discourse, and maybe this is something we can return to in the panel discussion. What I would like to provide the audience of today is an inventory of existing and possibly new tax incentives that we may expect to become more popular now in the aftermath of the implementation of Pillar 2. So, some tax incentives, as Rachel pointed out, will be targeted by Pillar 2 and many will not be. So of interest is for us then the ones that will not be targeted, that falls outside of the scope merely. So firstly, tax incentives targeting multinational SMEs, small and medium-sized enterprises. As we know, the threshold is set at 750 million euros, and small and medium-sized enterprises will not pass the threshold. Most of the multinational enterprises will not pass the threshold either, as we perhaps will return to in the discussion. This leaves plenty of space for countries to target both the MNEs that fall outside and these small and medium-sized enterprises that are engaging in cross-border activities. And given the steady increase in SMEs engaging in such cross-border activities, this could prove a promising venture for many countries. The downside, of course, would be that it would be disincentivizing for the growth of such companies in the long run, but once again, this discussion we leave to the side. Another important field that has come up more and more in the discussions is international maritime shipping tax incentives. Now, 80% of international trade in goods is carried by sea. A large number of countries already apply tax incentives to international shipping, and the number is even higher among developing countries. These companies additionally operate to a large extent outside of the corporate income tax dimension, as we will come back to, leaving plenty of space for tax incentives catering to these companies and this industry. Pillar 2 excludes international shipping income and qualified ancillary international shipping income from the computation of globe income and loss. And this is something I would like to highlight, that the implementation of Pillar 2 with this exemption has proven in some cases to clash with already pre-existing tax regimes. For instance, the Norwegian, the Dutch, and the British tonnage tax. Now, a tonnage tax system offers various tax incentives, such as exemption from tax on shipping-related income, capital gains on the sale of eligible vessels, and dividends received from shipping-related activities. Now, the classical thing, as we heard also with the tax treaty discussion, is that the conditions for exemption and the scope of Pillar 2, the terminology used there does not fall in complete line with the already pre-existing tonnage taxes, which also then leaves room for overlappings and falling in between. Those maritime shipping companies that will be primarily affected by this when implementation happens is those shipping companies that have a mixture of activities, alternatively have maritime shipping as their main activity, but with some side activities. Those who will luckily remain unaffected are those with 100% maritime shipping activities. So depending on the activities or how they're defined, parts of this profit may be subject to tonnage tax, while some parts are not. And if they then fall under the threshold, they will then be subject to the minimum tax. So this is something that has been very lively discussed in these European countries, as I do mention, the United Kingdom, the Netherlands, and Norway, but also Denmark, as these have plenty of these industries. What is also interesting is that from a policy perspective, we see public debates and political debates in many countries where the tax incentives and this very highly beneficial tax treatment of maritime shipping company has come more to light. And it's also been very much critiqued that they are exempted from the Pillar 2. Interesting enough, in Norway, just last month, a big governmental investigation into the Norwegian tax system was released. And in this investigation, we can read clearly that the investigating professor critiques this in the Norwegian system as well, and is even more concerned that Pillar 2 excludes. So there we have the discussion, or at least a suggestion from the investigator's part, that this should not be exempted, or perhaps Norway should implement more far-reaching tax rules. But this is once again something we can bring to attention during the panel debate. Another category which I find very interesting, and I've seen that has been brought up more or less in all panels before, is personal income tax and non-fiscal tax incentives. And here we can see a lot coming up the next coming years. Now, personal income tax has a tendency to fall in the shadow of corporate tax. It's not as interesting or relevant. But here we will be proven wrong. The EU is already investigating and trying to map among the EU member states what tax incentive regimes they are offering on personal income level. Because in reality, most of these tax incentives are offered to affluent or highly skilled workers. we have seen the discussions on Russian oligarchs and their favorable tax treatment in Cyprus and Malta. And here is a very good example of where you mix a complex mixture of tax incentives, beneficial tax treatments, and non-fiscal incentives such as golden visas or lenient judiciary or very opaque non-tax transparency. So what would say is common now for tax incentives in the personal income dimension would be tax incentives reducing or exempting income from the salary, of course. And then with that, of course, social security contributions. Pensions, we've heard. Sweden recently terminated their tax treaty with Portugal with this very reason in mind. Now, Portugal attempted to, for many years, to attract pensioners coming there by excluding or exempting their pensions from abroad completely. After several years of pressure from Sweden, Portugal raised the tax from 0 to 10, but this was not enough in accordance to Sweden, which then finally terminated the tax treaty, which in itself is quite radical, as we know. But this just shows also that as we may expect a rise in new tax incentives on the personal income tax, we also see many countries combating this more explicitly. So this will also be a very interesting development for the next couple of years. But of course, we have the digital nomads, so I do not need to discuss them more, but this is a very interesting group when we're offering both fiscal tax incentives and non-tax incentives. I actually have the Indian ETF group is coming out with their new book. And in this, I have a chapter on expert taxes, which is very common among the European member states for highly skilled workers, academics, industry experts, but also board members and high-level managers. They are offered either a reduction of an exemption of parts of their income and social security contribution, alternatively a radically lowered tax rate that would normally be subject to. So there's plenty of tax incentives here to be discussed further, and which will be becoming more interesting for these countries now when they're trying to rearrange their tax incentives plans and strategies. But in conclusion, any tax incentives that is not based on corporate income will still be applicable and of interest in the light of our post-Pillar 2 introduction. I think I kept time.
Yeah,
yes,
perfect.
Thank you.
Yeah, so thanks for that presentation. So you just set the scene for a discussion on tax incentives. So as you heard already from Professor Yvette Lind, some incentives are still possible in the corporate tax area. A lot of incentives are still possible in the personal income tax area, which is completely unaffected by the GloBE rules. Now, for coming back to the GloBE rules, you spoke about the international shipping income exclusion. So you can offer tax incentives to the shipping industry. Many countries are contemplating that right now. In addition to this, there are some other regimes also which countries can adopt. These are the qualified refundable tax credits, the marketable transferable tax credits. So Hakeem, as a reaction to Professor Lind's presentation, could you just walk us, share your opinion on what is possible, what is not possible in the post-Pillar 2 world?
And only in 3 minutes, right?
Yes, in 3 minutes.
I try to do 3 minutes, and I promise not to speak very, very fast. I think the question of tax incentives in Pillar 2, and I'm ignoring the personal income tax for now, otherwise it goes too far, but I agree with many things. It raises a whole host of interesting questions. Let's start with shipping. Shipping is an interesting one. Shipping is the only sector that has been carved out from the global minimum tax. Now, why is that? That's not a decision by the Secretariat, that's a decision by the members. That's a decision by all of those that sit in the room, by the 140 countries. What are some of the arguments that were being made? And they're sort of interesting if you think about it also from an academic perspective. That we have lost the race to the bottom in shipping and we couldn't bring it back is one consideration, right? Because essentially nobody taxes shipping. Tonnage taxes, other taxes. Now, there's a shipping cycle, as you will hear from the ship owners, and I was on German television making that point, so if you speak German, there's a cycle here, of course, and so maybe there are good reasons that maybe shipping is different, and these things you can reflect. Countries also feel that shipping isn't just a commercial activity, but it enhances the strategic interests of countries. So it's just a demonstration of the nature of these discussions and where these compromises take you and wider compromises that countries do when you need to come together to achieve results and come to compromises. And this is one. And I guess, as I said on television, I also say here, there's no natural God law that would suggest that shipping cannot be subject to the global minimum tax. But these are decisions, there's reasons for these decisions that you can also articulate. When you then move into Pillar 2, and this is sometimes that we hear quite simplifying. People say, get rid of all incentives, go to 20%. Now, if you are a smaller developing country, maybe that wouldn't be such a good proposition for you because you still need investment. So we had a very long discussion, which sometimes I would have hoped that people could have followed and seen the journey of the design, where I think individual countries would come in and say, there was a debate. There was a debate where some people say we shouldn't have a substance carve-out, right? We just tax all the income, it doesn't matter what happened in the country. And other countries were more thinking traditional CFC rules, only if it's artificial. And we said artificial we can't have qualitative judgments to assess how much substance, the other thing. So we ended up with this substance carve-out, but if you think and you put together both the economic literature and some of the factors that you see, particularly in smaller developing countries, many of the incentives in smaller developing countries are very specifically based and targeted to capital investment and labor. And that is the base on which we then compute a carve-out from the minimum tax, so there is a cushion in some sense that the minimum tax doesn't attach. And that's not a coincidence. That was a specific outcome of the discussion, despite the fact that Mr. Zuckman wants to call it a loophole. It is the total opposite of a loophole. It is something that we discussed quite extensively. And if you look at the economic theory, it also shows you that typically, A, expenditure-based incentives are more effective than income-based incentives, and we're not saying you can't have incentives. And two, that when you still want to have investment, it's that sort of marginal investments, that cost plus return, it's those investments people no longer make. Whereas when you're in the excess profits, you're basically just giving up rent. So if you think about the design, there was a lot of reflection that went into the design of this. So that means, in terms of the incentives are still possible, right? It depends on what sort of incentives you have. And let's also be clear, if you go outside the tax system, it still comes in the ETR calculation, right? Because it's still a benefit that's treated as income. And let's also be clear that essentially we follow accounting. So the accounting treatment already draws the distinction between a refundable credit and a non-refundable. So it's not something that the Pillar 2 has invented. So the message, I think, on incentives very generally, there's a question on shipping, but that's a political decision. And then in the incentives, I think we can have more of a discussion, but it's a measured picture where actually if you think about things that the pillar in some sense enhances or allows, immediate expensing and some of the effects, there's a lot of economic theory that also came into the consensus and the design of the structures that are now embedded in the pillar. And there was more than 3 minutes, but I stopped.
No, but that's the kind of discussion we need to have, right? Yeah, so you're pardoned for that extra 1 minute you've taken. No, so yeah, on the incentive side, so post Pillar 2, incentives are still possible, especially the expenditure-based incentives that you were referring to. And we see a lot of movements in a lot of countries around the world where a lot of countries are adopting their tax credit regimes and trying to make them compliant with the Pillar 2 framework. And in addition, they are also thinking of other incentives such as full expensing of tangible assets or accelerated depreciation provisions. You saw that recently in the UK budget. They said, okay, we are just going to adopt extra, very generous rules on full expensing. So all these incentives are still possible in the post-Pillar 2 world. So that was, we just parked the topic of tax incentives, and then we can have a Q&A discussion with all of you also here. But we just moved to Dr. Amar Mehta right now, and we are asking him to address another topic which is tightly interlinked with Pillar 2, which is whether does it make sense from a policy standpoint to get rid of all other anti-avoidance rules such as CFC rules, thin capitalization rules, once Pillar 2 rules are adopted by a country, whether it's QDMTT, IR, New TPR. So your views on that, please.
Thank you. You want me to go there or?
It's up to you.
Okay, it's just a few talking points. I think it's easier. So, yeah, this is a very interesting question, that what could be the implications in case of, say, an investment structure where Pillar 2 provisions are complied with, in the sense that there is no negative implication from Pillar 2, could a taxpayer take a view that that itself should shut out GAR or CFC rules or the principal purpose test or PPT clause in a tax treaty? Or is it that the Pillar 2 rules are just one more set of anti-avoidance or anti-profit shifting tools in the toolbox of the tax authorities? So, for an example, consider a scenario where an M&E group from one relatively high tax jurisdiction uses an SPV, special purpose vehicle, in another jurisdiction, which is a relatively low tax jurisdiction, for investing in a subsidiary in a third jurisdiction. Now, the nominal tax rate of the SPV's jurisdiction may be 15%. So that's one aspect, but I wouldn't use the word effective tax rate, but the real tax rate in case of that SPV goes way below 15%. Such a scenario cannot be ruled out. We can already visualize, and it's easier than one would contemplate to have such situations. Could the tax authorities of the ultimate subsidiary invoke the GAR? Alternatively, could the tax authorities of the first jurisdiction, where the MNE's ultimate parent entity is situated, could they invoke the CFC rules? So, before we get into that, we need to look at the main objective of the GLOBE rules. The main objective of the GLOBE rules is to ensure a level playing field for all multinational enterprises in a manner such that they pay at least a minimum level of tax in each jurisdiction in which they operate. But what if, as a matter of fact, they are not paying that minimum level of tax, maybe due to certain carve-outs provided in the GLOBE rules, etc.? Then what happens? Could GAR apply? Could CFC rules apply? What if the tax authorities in the jurisdiction of the ultimate subsidiary, they view that this is a case of treaty shopping via stepping stone technique? Could they invoke GAR, or for that matter PPT clause? In my view, the GLOBE rules per se should not negate applicability of GAR. It does not mean the GAR should apply on its own, but what I mean to say is, just because the GLOBE rules don't lead to any adverse implications for the MNE group, that per se does not mean that GAR cannot be applied. Depending on the facts of the case, the GAR may or may not apply. In other words, it's important for a transaction structure to be GAR tested, CFC tested, PPT tested, etc. So this is what I think. There is another aspect when we are talking about CFC. In a lot of scenarios, the GAR, sorry, this even if the GLOBE rules apply, it's likely that the structure is likely to trigger application of the CFC rules as well. So I think that would create a lot of problem and genuine hardships. So I think if the GLOBE rules apply, there need to be reasonable provisions in the domestic tax law that the CFC rules should not apply. And so I think this is likely to increase the complexity and compliance burden for the taxpayers, because on one hand, they have to GAR test the transaction structure or the investment structure. They have to take care of PPT clause, they have to take care of CFC rules in the residence jurisdiction, but now they have to take care of the GLOBE rules as well. This is what I think. So I think, I know it's less than 10 minutes, but that's what I wanted to say. And if there are any questions, we can talk about it.
Yes, so actually the question that was raised was, I think before let's take a few steps back. So if you think about the Pillar 2 rules, so one step before. So you have your existing corporate income tax system. For example, in India also, all the corporate taxpayers, they file a corporate tax return. Now the basis for making all the corporate tax calculations is your financial accounts. You start with your financial accounts, then you make these adjustments which are provided in the Indian income tax law, and then you basically come to your taxable income base, then you apply your tax rate to that, and you pay taxes. So that's the existing system. Now then you have the GLOBE rules. The GLOBE rules is an add-on to the existing system, and this existing system is tightly interlinked to the new system, which is the GLOBE system, is tightly interlinked to the existing system. What does that basically mean is that if you think about it, all the numbers which are flowing into the GLOBE calculations, they're linked to the existing system. So the numbers you report in your financial accounts, the numbers you report in your tax returns, sometimes because as a result of tax audits, there could be some extra payment of taxes or refund of taxes. All these changes which you make in the existing system or the numbers you report in the existing system, they are the base for the Pillar 2 calculations. So whenever you make some changes in the existing system, they also impact the calculations in the new system. In some cases, the outcomes which are provided in the existing system are also taken into account in the globe system. Like, for example, CFC taxes. So any taxes paid pursuant through CFC rules, they're somehow taken into account from the perspective of the IIR and UTPR. For QD entities, the stories are a bit different. Pushdowns are not permitted. Any thin capitalization outcomes under the existing system, they could have some spillover effects on the globe system. So Akim, your views will also be appreciated on this about what do you think about whether we still need to have these, just to simplify things, because everyone says globe is complex. As a simplification measure, let's try to simplify the existing corporate income tax system, get rid of thin cap rules, get rid of CFC rules, just focus on globe. If that becomes the new...
1 minute perhaps, just briefly, thanks for the question. I think, one, it is true, the basic policy proposition of Pillar 2 was to take the existing environment and then only create a top-up tax where there is a top-up tax to be created because there isn't sufficient tax levied yet, right? So for instance, CFC taxes are credited, withholding taxes are part of cover taxes. So you take the landscape as it is, and the policy driver really was that people felt that while we had done BEPS 1, essentially a lot of the underlying drivers of the profit shifting was still unaddressed, which is a very substantial discrepancies in effective tax rate, right? That's the underlying driver. So then we created a systemic solution in the Pillar 2. There is a discussion now in a number of countries, and you see this, whether in the wake of the introduction of a systemic solution to profit shifting, there's other things that can now be removed. So many countries introduce different measures that may have had the same target. Do we still need them? We don't need duplicative rules, and we could potentially remove them. We did a report for the G7 presidency where we went into some detail of this, and there is a discussion about the sorts of measures you may no longer need, and this may also come back to the panel we had this morning. Is there ever going to be, I think Professor Singh, is there ever going to be a simplification? There is certainly a simplification possibility inside the Pillar 2, noting as well that the data points in Pillar 2 are not your typical facts and circumstances transfer pricing data points, but they're largely, or to a large degree, audited financial accounts points that are already being reviewed, allowing also some of the more systems approaches in the compliance realities of tax administration. So there's some of the avenues that we're pursuing.
Yeah, so thanks for that. Just a follow-up question on this, because we also touched upon the topic of GARS. The question is very simple here. Assume now taxpayers, they somehow try to, first of all, do you think that top-up tax rules are bulletproof? Can they still be gamed by multinationals in some situations? Can they enter into schemes or arrangements so as to avoid paying these top-up taxes? Number one. If yes, the second question is, how do we tackle these schemes? Do you think we need specific anti-avoidance rules to counter some specific transactions which are used by MNEs to avoid payment of top-up taxes, or whether we just fall back to the general provisions, the general GARS?
I will have it with Rashmi, as he said this morning. I think we could save a lot of tax audit resource if there was less creativity being generated by parts of the taxpayer community and their advisors. So, people have been starting to come up with ideas of how you could undermine the CBC safe harbor, which is not a terribly good idea, because now we need to come up with a rule that stops the arbitrage, that stops the CBC safe harbor from being active. So we're hoping that the community in some sense regulates itself, because what you end up doing is you do one clever scheme that's, a short-term gain for one advisor, long-term pain for all businesses that now have complicated rules. But it's not the inclusive framework. So there is a bit of this. I think there will be situations where people will try to gain Pillar 2, people will have to react. Hopefully, and I think there is a pretty large stakeholder community in the business community that has no interest in this. And so we're also hoping that maybe this sort of slightly changes, which also opens up the door for thinking about where are there duplicative measures. You need to be specific about what is duplicative. It will not be the case that you can get rid of absolutely everything. It will also depend on the country. Decluttering in one country may be looking different in a different country. I think if you think of Switzerland, it might be a very different dimension to some of the other countries. But I think there clearly is a possibility, having done something quite systemic and if it is sustainable and it works, to then also remove certain other things as you introduce it to remove certain other parts. That's certainly a possibility that we want to explore.
Okay, thank you. You want to quickly react?
Only on your first question, I would like to say whether the double tax rules or anti-avoidance rules can be foolproof. My view is always no, because there is always a cat and mouse game, as we say, because there are high stakes involved. The tax authorities or the countries want to have a fair share of tax raised, but there are stakes for the taxpayers. So I think the answer is no. So I believe now we have pillar 2, we'll have pillar 2.1, 2.2, and that's natural. It doesn't mean that there is any weakness in any pillar 2. It's just a normal, it's like in everything, it's evolution.
Yeah. All right. Thank you for that answer. So we move now to Chetan, your presentation, and well, you have a choice. You can sit down. Or you can
No,
go to
no,
the
I'll-
podium.
yeah.
All right. Well, it'd be nice if you could also comment on 2 topics. One is on the treaty compatibility. Hopefully, you have a dissenting view from mine. and basically capacity building.
A very good afternoon to all. And before I start my presentation, I'll just make the disclaimer that I speak here in my personal capacity. So my views don't represent that of the government, and they are only my personal views. So to begin with, I have a slightly different view than what Vikram had presented.
Thank you.
So before going into the compatibility of globe rules with tax treaties, I'll just like to draw something from what the first introductory presentation that Rachel had made. That was about how the globe rules operate. So you can frame it in a different way. So there's a tax treaty world and there's the globe. There's the globe realm, or you can call the paradigm, or you can frame it anyway, but they're 2 different worlds altogether. And if you see the tax treaty world, it basically consists of a separate entity concept. You have the permanent establishment, you have the rules for how you resolve the disputes, you have rules of how you actually attribute profits or you allocate profits. So you have a set of rules. And just like Akim said, that these rules are untouched when you have the globe. So on top of it comes another paradigm, you can call it realm, which is the globe. And a lot of times I have heard that some people would not even like to call the globe rules, but they called globy rules. So they just want to separate out from the globe. So these 2 paradigms actually, when they interact, at a lot of times, when we see them separately and when we see their interaction, at a lot of times we feel, yes, there is friction. So this friction, I like to compare this friction to something what, as you must have seen that presently, if you have children especially, they are very quite interested in Marvel movies and DC movies. So in that you have the multiverse, and then you have the multiverse colliding, and you have the multiverse of madness. And plus there was an Oscar-winning movie in which you're everywhere. So that was also about the multiverse. So it's something like that. When 2 realms are interact with each other, obviously there'll be friction, because I remember Vikram actually talking about friction. There's friction. I was saying, yeah, now we need a lubricant also. So there it is. So when we talk about this, this friction, so-called friction, so first thing we have to remember is that how actually globe rules came. So it was part of the October 2021 statement of the inclusive framework, and that ultimately got translated into model rules, and they were administrative guidance. So I'll just like to refer to the February 2023 administrative guidance on the globe model rules, which has been approved by the inclusive framework. So it actually addresses this question, and I put the quote from the administrative guidance, and it actually tries to answer this question, that the design of globe rules, the way they're designed, actually is compatible with the provisions of whatever are contained in both of the model rules. So that is what it says. So if you actually look at it from a holistic level, these globe rules are actually designed to take care of double taxation. Because once you have the normal treaty world, they are on top of it. So just like Akim had also described it. So looking at the first level, so if you look at the first level, if you look at a very holistic level, rather than picking up the various components, the globe rules are very similar to CFCs. So they are actually called CFC plus. So when there are no issues with CFCs, even though this comes with a disclaimer that there might be court decisions, but it's a generally accepted CFCs are acceptable. They are part of the commentary in both OECD and UN. So what's the issue? So this is the first level. Now coming to level 2, the globe rules actually sit on top of tax treaties. Now just to scratch the surface, now we have some examples. Now if we look at those examples, but you can't really have those fact patterns because they're not actual fact patterns. Because if you see, there is a carve out for MNEs who are above which are in scope of these globe rules, which means they're certain size, but are in the early stages of internationalization. So those are out. So once you look at actual tax patterns, the fact patterns, so what do we see? So like, how does the UTPR actually work? Just like Rachel in her presentation had expanded this, that if you look, UTPR, when it operates, it actually pools profits from those low tax jurisdictions and then allocates them with the allocation key. So if I am a country which has adopted the UTPR and I get that some part due to an allocation key, can I really say that this came from country A or this country B, which are the low tax countries? It's really difficult to point out. But that is how bilateral treaties operate. It's very difficult to say that this profit is actually part of that because it's a pool. So in that pool, all the low tax profits actually are dropped in. And what I get, I really cannot really point that this is this country I got those profits from. So on the second now, when we're talking about this, if you see that UTPR does not link it with net profits. So the UTPR tax charge there is no link actually with what the net profits are actually being generated in the UTPR jurisdiction. And another thing is that it is, if you see that when the UTPR charge is there, probably in the form of deduction or it may be equivalent adjustment, but there is not a corresponding reduction in profit in the other territory. So this basically deals with Article 9 frictions and also Article 7 frictions, because why it deals with Article 7 frictions, irrespective of the model, what we talk about, we've talked about the UN model or you talk about OECD model, because they actually apply after the profit attribution and the allocation, everything has been done because they sit on top of it. Now coming to the non-discrimination, so actually, if you look at it, if you apply the non-discrimination, it should be between those which are in similar circumstances. So they actually cross all those tests which are in the non-discrimination article. And now lastly, coming to the elimination thing. So at a lot of times it's said that they do have a friction with elimination. So I'd just like to step back and go in 2019. So in 2019, when first time the globe rules were introduced, it consisted of actually 3 rules. So there was the IRR, there was the UTPR. At that point, the name, it was a payment rule, not a profit rule as it is now. And there was a switchover rule. So that switchover rule was actually from those countries which had the exemption, and they thought that given that we have an exemption system, so it might create the problem, something that also Vikram was talking about. But gradually, as the discussions evolved and things progressed, even those countries actually realized we don't need it. So it was a very conscious decision that we don't need it. So that's why, because they actually realized that elimination of tax would not actually create a problem. So this is on the level 2. Now coming to level 3, so some commentators in their writings have actually said that, look, fine, this may problem, but if you see the globe rules actually violate the customary international tax law. So that's the basic argument. You're taxing which is not based on economic substance. What is this agreement? It's just a commitment. This October is just a statement. Countries have not actually implemented them, so you cannot call it actually customary law. So, to which I would like to say, one, I would like to point out to the administrative guidance, which is agreed by the inclusive framework. Second, I would also like to say that this is at this given point of time, but since, just like Rachel had also showed in a slide, that countries are now adopting, some have, and gradually it is being adopted. And so it's, what do you call when countries agree that, yes, it is compatible, and yes, we would like to adopt it. So customary international tax law cannot be static, so it has to evolve. And this is all part of the evolution. And lastly, I will say that everything what is out is actually approved by the IF. So before coming to conclusion, I would like to also make one statement, which is that at the start of this whole project, when we were discussing globe rules, India had a position that this should be implemented through a multilateral convention. We had that position. But as the negotiations progressed, and many countries actually realized that given the way they are, it's better to have a common approach rather than adopting a multilateral convention. So to conclude, I agree with Vikram on one point, that there are some countries who would want to adopt safeguard clause given their jurisprudence or constitutional reasons. And we can see an example in the Belgium-Netherlands Treaty recently. Secondly, I agree with him that there can be problems with in interaction of globe rules with bilateral investment treaties, because there's a case, a Romanian case, which is called Micula, which was a bilateral investment treaty. So it happened when it joined the EU, and we had to withdraw state aid. So there was an award against Romania. So it's a real danger, and countries actually will have to think. But then there are some defenses also, given the fact that it's a global agreement, that it's a paradigm shift in the form that you're moving something, what was also talked about in the morning, that you're moving from avoidance of double taxation to avoidance of non-taxation, and then coming to the very fact that now you're going to a minimum taxation regime. So, and regarding dispute resolution, which Rachel and Vikram had also pointed out, yes, that is a concern for some. Why is that concern when we're seeing it sits top of tax treaties? One of the reasons is that there is a flexibility in how, because it's a domestic law. So there's a flexibility on how you actually put it in your constitution. At a lot of times, just like we had a session on interpretation, so interpretations can vary, and that can create disputes. So there was a public consultation done on it, and we'll see something coming out of it. And lastly, if some countries still have concerns about the fact that they have an exemption system, obviously they can have something like a switchover rule in their treaties. So with this, my first part of my presentation, which was on the compatibility of globe rules, ends. Now I'll go to the second part of my presentation, so which is actually about capacity building. Because just like in my introduction, I talked about two realms. So we are very comfortable with the first realm, which is the tax treaty realm. So we as tax professionals and even tax administrations now, even though international tax is a quite a difficult subject, but now we are more or less comfortable. We have the capacity, we have people, but still capacity building still continues in that area. But when we get into the different realm of globe rules, there is a considerable requirement of capacity building. And this capacity building is not only required for the administration, but also for the government, because you need to adopt a whole of a government approach, because globe rules has not just interactions with something that on the tax side, but they also, given the fact that we have discussed that you have tax incentives, so at a lot of times a decision for tax incentive is not taken by the tax administration, but there are different departments also within the government who actually take these decisions that, yes, I want to promote this sector. Suppose I want to promote a particular sector. So the thing that probably let us give. So that decision might not be just of the tax administration, but of a different set of part of the government. So that is why the capacity building is very much needed. Secondly, if you see, just like we talked about it, financial accounting, because if you see the globe rules and even to a large extent pillar one, they start with financial accounting. But as tax administrators, mostly we start with the taxable accounts. So we start from that. This is the bottom line. So we start that how it actually goes. So reskilling of the existing workforce has to be done. And when we talk about reskilling, this reskilling has to be at different levels. So something, even when you have these rules, when you adopt it in domestic legislation, even for that you require skills, because you actually need to understand what you're actually doing. You just can't copy. There is one model that there's a country that just did 3-4 lines and said everything, whatever is there in OECD, we'll adopt it. But that is one approach. But is it the right approach? Probably that country is comfortable. But would there are other countries, would they be comfortable with doing that? So that's also a question. Another question could be that if you look at the returns, let's have the globe return, you take whatever figure is and you just have the QDMT, that's fine. But would you like to outsource your audit functions to somebody else? So these are the questions around this. And as part of the Indian G20 presidency, we had 3 priorities, and these priorities actually came from the very fact of the logo itself, that one earth, one family, and one future. And tax and capacity building was a very important part of it. And this was included because the Indian presidency actually saw that because of the various developments that are taking place in international taxation, we actually need something on capacity building. And as part of the capacity building, I'm not talking about the physical deliverables that were done, but only in terms of the 2-pillar solution, and especially the globe rules. So a request was made to OECD for having a handbook. So they actually accepted our request and released a handbook in October 2023, which is quite a good one. And as part of the G20, there were various dialogues and capacity building events were held for the developing country delegates, just to acclimatize and just to make them aware of what's happening and what type of skills, what needs to be done and what needs to be seen while adopting these rules. So in the July outcome statement of 2023, one of the last things was on this capacity building, especially given the fact that these actually changed the paradigm of international tax rules. So the focus of this was outreach, multilateral training tools, partner initiatives, and targeted support pilots. So as part of these initiatives, a lot of capacity building initiatives are already taking place. Like you have the FTA, which is the Forum of Tax Administrations. You have a capacity building network, which is for pillar knowledge sharing, which is led by the HMRC, which is the UK tax agency. Then OECD Secretariat is carrying out 10 pilot programs. So in these pilot programs, they deal with what the domestic legislation with, how to implement it, and also to sensitize the stakeholders of how it should be done. And it has also come out with the e-learning modules for both tax administrations and also for tax practitioners, so that they they are made aware of how these rules actually operate. And the Tax Inspectors Without Borders, which is a joint initiative of OECD and UNDP, is supporting the rollout of global minimum tax in developing countries wherever there is a demand for such support. And then regional organizations are playing a very important role. ATAF, SIAT, etc. are assisting their members. They're taking out guidance papers. They're taking out what should be done and what could be done and what needs to be seen. So even ADB is also working in the space. So it has set up website which is the Asia Pacific Tax Hub, which is a very good source for information, and it has also set up a help desk. So it's a very interesting concept. So where the tax administrators can actually, if they have questions, they can actually reach out. And then the platform for collaboration of tax actually brought out a toolkit on the options for low-income countries for the effective use of tax incentives for investment. So it is also a good or something what we talk about, the how to redesign your tax incentive. And the World Bank has also had a report. So these are some of the capacity building initiatives that are being taken place. So with this, my presentation ends. Thank you very much for your patience, patient listening.
Yeah. Thank you for that presentation. I just have a follow-up question for you, actually, because you spoke about capacity building. You spoke about how countries are going to adopt the Pillar 2 legislation in their national law, the direct reference approach or the detailed legislation approach. You spoke about the OECD's very good paper on implementation of GloBE rules. Now, are you giving us an indication that something's going to happen in India in next year?
So first to say that I come and I speak here in my personal capacity. So that's the first disclaimer. The second is my guess is as good as yours. I don't have that crystal ball, which Akim has. So I don't have that.
You're talking about India, not
Yes,
OECD.
because ultimately it's a crystal ball where I don't know what the tax legislation department is actually looking at, how they look at whether it will be adopted or not. So I can't say. But what I can actually say is that if there's a country, what it actually needs to see. So you first need to see where you lie. So what are you, a high tax? Are you a low tax? If you're a low tax, yes, you have that risk. So it's a normal risk strategy which we do, how we manage risk. If you're a high tax, then you need to look at something different. You need to look at something which has also been highlighted in the recent OECD working paper, which is that they did a study of where the low tax profits actually lie. And they found out that around 37.1% of the low tax profits actually are in high tax countries. So once you look at that, and out of this, if you look, around 56% of the profits are actually in countries which have a tax rate above 15%. So these are the cause of concern. So now you actually have to do an analysis and see, you being a high tax country, do you have such pools of low tax profit? And then how big is that pool? If it's really big, then you need to do a cost benefit, something what Rachel had also said. Actually, you need to do a cost benefit analysis. So this is all part of a continuum. So it's not a straightforward decision, because I have seen there are certain countries, I won't name a country, that country adopted the rules in a rush, but then after 6 months, the investment minister said, hey, you adopted that, but my investments will be hit. So that is why you actually need to take a step back, look at the implications, and actually and see whether that suits you. So it just reminds me of something. In college, there was a fad of wearing bell bottoms or having long hair. So would everybody have long hair and wear bell bottoms? Probably it might not suit you. So you got to see whether it actually suits you or not. So that's my reply to your question.
I'm confused. No, thank you for that. Okay, you've given some nice indications of where we are heading. So, all right. So, before we go to our final presentation, which will be made by Akim, where he was going to talk about the future direction of Pillar 2, very quickly, do any of you have questions so far on what we discussed? Please, sir. Mike, please. Well, probably this can be considered as a mini public consultation.
I have a very basic question. The objective of Pillar 2 is to bring a level playing field and have a minimum tax rate by all the jurisdictions. Now, this is being achieved through a well-meaning regime being put through. And but I remember that around 2017 or 16 there was a discussion about making it mandatory for all the jurisdictions to have a minimum tax rate. So now sometimes I wonder why that path could not be followed, that make it mandatory for all the countries to have a minimum tax rate. And now also it's being achieved through a different mechanism, QDMTT, or now many countries are raising their tax rate like Vietnam or UAE, 9%, 15%. So this is a bit of a confusion to me, and if this can be clarified.
This is a question for you.
It's a question for me.
Yeah.
I don't think, in fact, there was ever in 2016 or 2017 a project where somehow the OECD or the Inclusive Framework was going to tell every parliament in the world what its tax rate was going to be. So I don't think from a sovereignty perspective, if any delegate remembers these discussions, I don't think that was the discussion. I think also in the design, and this takes us a bit beyond the time, so I'm brief. I think what you saw at the end of BEPS, I think, it's basically two pieces where people were not fully satisfied, and maybe others, right? And we'll talk about them also tomorrow. But sort of in the space of what BEPS was trying to achieve, rather than the space where BEPS was not trying to achieve, but other issues that maybe should have also been done. But in that, I mean, one is that there was sort of a residual issue left, that people felt what we had done on Action 3, CFC rules, what we had done on transfer pricing, 8 to 10, that we were fighting the symptoms rather than the causes. And that one of the big causes was the big discrepancy in effective tax rates, and that we should go to the cause rather than fighting the symptoms. I think that was a sense that many had. And then the question is, how do we do this, right? And Pillar 2 emerged over several discussions in its design, and as Chetan was saying, in the blueprint it looked different and evolved over time. I don't think there was a time where we would bind parliaments to a particular level of corporate income taxes. So now you're right that there's a particular dynamic through these rules that create a level playing field that has effects, right? But I think that is different. And the second piece, of course, where people felt, and that's sort of the Pillar 1 discussion, that we weren't quite there, that if you look to Action 1 and the challenges arising from the digital economy, that while in some sense we noted in the BEPS action that there wasn't anything very specific from a base erosion and profit shifting perspective, right? There was something that we called the broader challenges. And you remember the last chapter, also looking at Chetan, where some of the Indian equalization levy was in there, and we said we note it, we don't recommend it itself, but it was already in there. So it set up for a wider discussion. But that, in some sense, was an allocation of taxing that discussion, not so much a BEPS discussion.
I hope that answered your question.
And otherwise, I'm happy to follow up later.
Yeah. Or you are as confused as me with respect to Chetan's question. Chetan's answer. No, so thank you for that answer. Probably you can have a follow-up discussion on this. Any other questions from the audience? Please, Michael.
Customary international law question for a bit of variety, because the issue was raised. It strikes me that quite apart from whether there's any customary international tax law and whether it's anything the UTPO is contrary to it, you have the obvious question, would it actually matter? Because certainly in Australia, the courts would say, well, first of all, countries can agree to depart from customary international law between themselves. Secondly, as long as the legislation is clear, it's not for us as the courts to look at customary international law. So, you know, sometimes people miss out that analysis of would it even matter if there was a breach of customary international law. And I think sometimes they mistake customary international law, which countries can agree to depart from, with the so-called jus cogens, the customary international law that you can't depart for some very, very serious matters. But I'd be interested in your thoughts on that. Thank you.
Yeah. Michael, I absolutely agree with you that when I was saying that, what I was actually referring to, I was referring to certain articles from the commentators. So I took the arguments that were given in those articles. If you see, I actually tried to delve it at 3 levels. So in the level 3rd, because once we say they're on top of the tax treaties, their interaction is not the way the people think. It is, because you can't actually in UTPR recognize that which tax jurisdiction belong. So they say, no, fine. That's fine. The next level is, it actually breaches the customary international tax law. So in that context, you're absolutely right. Where would you challenge it? Because which court? Because if you actually challenge it in the domestic court, the courts will say, we are not competent even to deal with those things. The legislation is there, it does not violate constitution. Fine, let's go ahead. So now the next forum would be probably the ICJ. So would countries actually go there? Because they are already agreed. So you're absolutely right with what you actually said. Thank you.
Okay, thank you for that. I think a lot of people here we somehow think that it's a bit in the air discussion when we talk about potential conflicts with customary international law, with tax treaty law, but that's hard law. I think that's a separate issue altogether. But with customary international law, it's a bit in the air, the discussion. So I think we've taken a couple of questions from the audience, and probably Akim, you can talk to us about the future direction of Pillar 2. By the way, just to let you know, the conference director, Mr. Bhutani, has graciously allocated 10 additional minutes for this panel. Yeah.
So I can speak really slowly and take a lot of time. All of Pillar, and I too talk about Pillar 1 and BEPS and automatic exchange of information. A couple of observations, and then the slides, I hope, will also come up. This is the first slide, and it's essentially what Rachel has said, so I don't need to run through the slide, but a couple of observations I think are important. I mean, picking up what Chetan has said, when you look at the recent numbers, it actually is quite interesting, and that also links to the incentive conversation about how much of low tax profit is actually in high tax jurisdictions. You see these pockets, and sometimes you don't know that to the full extent. And that also ties to the incentive conversation, because some of the big challenges, I think, both in developed, but also in particular in developing countries, is the accountability and the governance around knowing actually how much money is going into incentives that have been set at what. So just the awareness and the governance around it, I think, is a big topic. Maybe then, on these points that you see on the slide, maybe just 3 observations, I think, and I'm trying to focus here specifically, as Vikram, as the chair has asked, on the challenges for businesses and the complexity, but also on the complexity, let's call it, for developing countries, or more specifically for countries with lower capacity, and try to focus on those. And one of the things that also sometimes is so obvious, but it needs to be stated, is that the easiest way for instance, a developing country with very often a relatively high effective tax rates and assuming not a lot of incentives, the easiest way to benefit from Pillar 2 is to do absolutely nothing. Because what is actually happening, that there is 50 countries and more that are taking action so that the level of taxation that at the moment was you are at 25 and maybe some low tax jurisdiction was at 0, and maybe you're not actually at 25 because your effective tax rate is maybe more like 20, it's going up to 15. And so without you actually having done anything, you've just gotten more attractive. And this is also what every study shows, in particular when you look at the tax elasticity. So the propensity of profit shifting is much higher when it goes up. It doesn't go in proportion. And again, that's what every study shows. And when you look at those numbers, which we will refresh in a moment, in 2 weeks, I think we'll come up with slightly updated numbers here. A very significant part of that number is the profit that results from behavioral changes, because now you're making the investment where commercially and pre-tax you would have made the investment. Now, where is this going to be? We don't know. It could be closer to the market. It could be closer to the infrastructure. It could be to the sorts of places that at the moment miss out. And it's also fair for those that have worked in planning that a small discrepancy in effective tax rates doesn't justify the additional cost of running a more complicated operating model. So for profit shifting to pay, you're not going to do it for 1 or 3 or 4 or 5 percentage points, because typically it involves a commercial operation that is more complicated, more costly, and it also increases your audit risk. And when you factor all of those in, you see that in some sense, the first reaction of a country with low resources could be to just go for the ride, because the Pillar 2 is actually a beneficial thing for all countries that have, an effective rate that's above 15%. And then I think you can go further, and this is the question, right? If you then look at your own jurisdiction and you detect that there are tax incentives, Now, it's true, as Rachel says on the slides, you couldn't see it, but you could see it. Like, there is some resource that is involved to think about whether these tax incentives make sense. And I think there people should take Pillar 2 not as a, I must comply with Pillar 2, but more, there is perhaps an opportunity. There is perhaps an opportunity that maybe countries should have seized a long time ago to rethink some of their incentives. Some of them have been in place for a long time. Maybe the industry has moved. Maybe this isn't the sector that is your future. Maybe that was the future 10 years ago. So there's a lot of opportunities in thinking about this. And as I will say in a little while, you can do a QDMTT. You can also do other things, right? But certainly you can think about a QDMT as well as other things. These are perhaps some of the early comments, and then let me move on with my slides here. Just again to remind ourselves, and that's what you've seen, the pillar does what the pillar is estimated to do, right? And this shows you where and what effect it will have on profit shifting. So you see a significant reduction of profits booked in investment hubs, and you see an increase in high income, you see upper middle income, you see an uptick, not insignificant, in lower middle income and in low income. These are all the pockets, and this is where the profit would fall under a number of scenarios that we've done. And then maybe also moving on a bit, because this is sometimes a bit confusing and difficult to understand. Like, how does this actually work? There's sometimes this narrative out there that Pillar 2 only benefits the residence jurisdiction. Only the rich countries benefit from Pillar 2. Now, let's look at this in terms of how it plays out and look at it in the real world. First, you look at the real order. And in fact, the subject to tax rule and other taxes at source come first. And that's normal, right? Because you credit them in the residence jurisdictions. That's first. Then you have other cover taxes, whatever they might be. And the definition of cover taxes is extremely wide. Then you get to the domestic minimum top-up tax, and you're still, so to speak, in the source country, before you then get to the income inclusion rule. In fact, some residence country might be a little nervous because conceptually, if everybody does your QDMTT or otherwise increases cover taxes, the residence countries don't make money. But the point also isn't from the proponents of the Pillar 2 that this is meant to make money for residence jurisdictions. And this is what I said at the beginning, the policy rationale that the advocates of those have more in mind is that we reduce the arguably distortions that are introduced to very substantial differences through effective tax rates, and we look more at the pre-tax return, which people find more beneficial for the allocation of resources and investment decisions, right? Now, at the same time, we're also not completely eliminating competition, because that would also be a problem, in particular for smaller developing countries with not so big markets, right? And that's why the incentive discussion is so important, and to actually go through the pillar and its design. It says in the design of the pillar that the substance-based carve-out, the more your incentive is geared towards capital investment and labor, the less the Pillar 2 hits you. If you think about the philosophy, that's the principle of the substance-based carve-out, up to a cap. Because it does go very specifically to excess profits, to the so-called rents. Because there we don't see in the data the reduction in the investment that we would otherwise see. So there's also a logic of not inhibiting investment in developing countries through a lot of the design features. Now, I'm straying a little bit from what I'm meant to be talking about, so I'll do that now. What are the business concerns, and what are we doing in the inclusive framework? And one of the things I think that is also true, and I should stress it, I should probably use a logo. We need a new logo for the inclusive framework, because this is actually a discussion of the inclusive framework. We sometimes say OECD, and then we think about the 38 members. It's not the 38 members, it's the 140, 110 that actively participate in these discussions. Now, from the business concerns, what do we have? We have business concern number one, risk of inconsistency. Like, everybody is going to do it differently, it's going to be a mess, right? Now, what have we done to address that? One, there's a very clear rule order that's baked into the rules, including a QDMTT safe harbor. So if you meet that safe harbor, we basically take you out. Second, most of the data points that's actually important are from financial accounts. That's difficult for tax people that haven't worked so much with financial accounts. But as Vikram says, in many jurisdictions, that actually start the tax accounting, right? Like this is something that doesn't come so novel to you, and without criticizing transfer pricing, it's not facts and circumstances, right? It's data points from financial accounts with adjustment that are already in your ERP systems. There's a peer review process and an ongoing monitoring process. and see that also as a benefit for jurisdictions to talk to their peers and understand what they do. So there's a helpful component as well. There's a common return and an exchange framework. We have agreed administrative guidance to keep those rules together. And in some sense, it also depends how you implement the rules. Because if you are, for instance, implementing also the IIR, then maybe you only have to deal with one tax administration, your own. And so that reduces the number of frictions. And then finally, there's a tax certainty framework. And the tax certainty framework is a very important component. And I think that's been mentioned here also on tax certainty. Two tax certainty dimensions. One, and I may call out the contribution from IFA here, including its president, right, Mr. Maisto, including the contribution from Lausanne University. Like, I think we now have the first country, Italy, that has actually implemented in its domestic law a reciprocal provision for the resolution of Pillar 2 disputes. Now, Italy needs a partner, right? You can't do this on your own, so we're hoping we get a volunteer, we find another country, so Italy can actually solve them under reciprocal domestic provisions, which is a very interesting and very noble concept. Second, we're still working on a multilateral convention for dispute resolution to be quite targeted. So that work is still continuing. There's only so much space that all the delegates can take in, and so we're also working on guidance, but that's on the to-do list. So I think that's how we try to arrest the risk of inconsistency. There is compliance cost, and that's another risk. You know, one of the things to reduce compliance cost, and that's the most obvious one, I guess, is actually it's limited to 750. So it doesn't take SMEs in, so there are no compliance costs. You can go lower as a country if you think that actually makes sense, and some countries are thinking about it, and then maybe dropping their CFC rules, because otherwise, so there's a lot of thinking that's going on. But the 750 limits it to 8,000 to 9,000 companies in the world. It's still 8,000 to 9,000 companies in the world, but if you think about the number of companies in the world, there's a lot more. So it does actually take it to quite a reduced level. Then there's a number of features. I'm not going to go through all the features of the individual aspects. It is, as we said, financial accounts, bright line tests, transition rules, transitional safe harbors, and the de minimis exclusion. Maybe just suffice it to say that when we talk to the business advisory group and many of those in the business community, the CBC safe harbor is seen as tremendously powerful. It can reduce having to make the actual calculation to somewhere between, you may exclude 80%, depending on your footprint, 75, 80% of your group operations. And then if you also look at the de minimis one, hence where you like small, you may actually be able to do this on an Excel sheet for the remaining ones in the transition when you build the data points. Then maybe last year, data availability. We did a lot of things in the global information return. I'm happy to go in this into more detail. We've also done a couple of permanent safe harbors that we've also done to reduce that. So there is an active conversation, I think, with those in the business community affected to streamline and simplify the application of this. I should also say this, and this is what I guess we're doing in session 6, there's a couple of people in the IT space, and that should appeal to the Indian IT community that actually want to put Pillar 2 in the cloud. There's a lot of data points where you can have, and there's a couple of people that will put the source code of Pillar 2 open, and I guess they're going to release it, so you can build programs around the Pillar 2 compliance, because it actually does lend itself to a technology solution given the data points as they emerge from the financial accounts with the adjustments. You need to have it in your ERP systems, but from that you can take it. So there's also in some sense an opportunity to look at easier compliance, which doesn't save you from the build costs. And then on my remaining 1 minute, 2, 1, good.
We've actually exceeded the time, but...
Oh, okay. I'll be quick.
Continue.
Okay, maybe then just very quick. On QDMTT, there is concerns by business and there's also concerns by others about the complexity of the QDMTT. There's a complexity overall because the QDMTT is not different from the IIR and the other rules, so it's not more complicated, right? Maybe 2 points. I guess from the business side, the ideal scenario for business would have been the QDMTT is calculated under the parent standard, and so you run one calculation for the whole world. And then you run into the reality of sovereignty that a country says, well, wait a minute, this is a local tax. I want this local tax to be based on I want to be able to audit this local tax under my own standards, so it can't be quite that. We balanced this out with a QDMTT design that gives business as much as we could do, but recognizes the sovereignty, concerns, and rights of countries. And that's the balance that came out. From a country perspective, if you are a country with relatively low capacity or lower middle income jurisdiction, the first question to ask is, what they do is ultimately, does this make money? And it does make money in many countries. As you can see, overall 4 to 8% increase in CIT through the implementation of a QDNTT is what our number shows. This is an average, but this is not insignificant money, right? That is currently available and otherwise would be taxed in another jurisdiction, right? So there is some money here to think about it. It does not increase substantially the tax cost for the in-scope M&E because they got to calculate it anyway. It does not affect the jurisdiction's ability to compete for investment because that money is going to be paid. The question is it going to be paid in your example, Korea, or is it going to be paid in Vietnam? There is a relatively low compliance risk because there's a multilateral dimension to the compliance work, and there is little additional cost to impacted M&Es. And I guess I'm happy to look at Chetan, at your slide, in terms of the capacity assistance that can be provided, also to make sure that jurisdictions can actually audit this. The last point, sorry for this, I think is just looking ahead, and I think that's the piece that you wanted me to talk about, so I do it quickly. What's coming next? One, administrative guidance. I think in particular the CBC safe harbor, I'm happy if anybody's interested to go into more details later on, I'll skip that. Exchange of information, tax certainty I have mentioned, and also work on the qualified status about how this works. So I think Pillar 2 does bring opportunities, it does bring complexity, but that's just a challenge to the Indian IT industry to fix that. Thank you very much.
So thank you for that presentation. So just to summarize, what did we discuss in this panel? So from the tax treaty side, yes, we have diverging views on whether or not conflicts arise. That's fine. It's good to have difference of opinions. Tax incentive side, of course, a lot of opportunities still exist for countries to compete post Pillar 2. It's not that tax competition is dead. Countries can still compete within the parameters, the boundaries set by Pillar 2. A lot of opportunities exist. We spoke about the interaction between normal anti-avoidance rules with the Pillar 2 rules. That's a policy question, which I think countries may have different approaches to. And we also learned about the future direction of Pillar 2. So thank you. I think it was an interesting panel. Not many people of you left, so that's a good sign. I hand over the floor to our conference directors, Mr. Bhutani and Belema.
So I want just to do a quick thank you to you as a panel and to Rachel for the overview. I've really enjoyed working with you over the past weeks, and I guess whether you see friction or a lubricant, clutter or an opportunity, I think that you have been able, with your expertise and your passion, to show everyone here all of the opportunities ahead. So thank you very much for, thank you very much.
Well, I now call on Ms. Belema to please give us a closing remarks on today's sessions. Thank you. Thank you, Rebecca. Thank you.
So this brings us to the end of day one. And of course, I think we'll all agree that it's been really a positive and inspiring day. It started, of course, with a nice, warm commemorative event for Roy Rohatgi, who we're all very happy to see after such a long time. And this was followed up by a really enriching address from Justice Sikri. And I think it was especially revelatory for those of us who are from outside of India. As you all know, India has a very rich jurisprudence, and it's always a pleasure to listen to the evolution of law in India, and especially to hear it from Justice Sikri, also looking at it from his own personal experience. I think that was really a very, very rewarding session. And then, of course, we've had our 3 technical sessions today. We've looked at an overview of evolving trends, the tax implications for that, recent developments in Indian tax in the last year, and we've just now seen on the global minimum tax, preparation for the global minimum tax, challenges that businesses will face, and also governments, etc. We, of course, also had a very, very insightful keynote speech from Michael Leonard of the UN, And among other things, he gave us really an overview of the current UN process, also corrected a lot of the misconceptions that have been around, and also gave an invitation for us to follow along in the process and engage to the extent that that is possible to do. So that brought us to the end. I mean, all of this today, that's brought us to where we are now. And for tomorrow, we have really another exciting and a rich day. We have sessions on transfer pricing, tax treaty issues, emerging technologies, and we'll end with a very interesting session on the evolving global landscape, which we are hearing quite a lot about, and India's place and India's perspective in that. We will also have our second and really keenly awaited keynote address from Dr. Akim Pros from the OECD, and that's, of course, on the future of global tax policy making. So we're really looking forward to that as well. So until tomorrow, just first like to thank you for your attention and engagement today. Wishing you a nice evening and looking forward to welcoming you back tomorrow morning. Thank you.
Well, thank you very much, Ms. Pelema, for that. Before we leave, ladies and gentlemen, we do have, I would like to invite Mr. Shardindu Vajpayee from Amicor to give us a short brief about his company. So please, sir, please grace us with the occasion and give us a little brief of your company. Thank you.
Hi, good evening all. I'll not take much of your time because it's been a long session. So I think the genesis of my company would start with the sessions what you have done on the GA, BEPS, POEM and all that stuff. Because all these, the life stories or the case studies comes when the companies go abroad and incorporate the entities and start doing their businesses. So there is what we do. Can I have the... So I'll just run you through what we do. So we are a boutique fiduciary company which is present in 35 plus countries with our own offices in 40 plus own offices in 35 plus countries. So primarily our business line is to incorporate the corporate entities in different jurisdictions for the large corporates. And so right from the incorporation stage to get the licenses, to keep the company in good standing, to do all the company secretarialship, that is what we do for our large corporates in different jurisdictions. So except for the audit and except for also not advising our clients on the cross-border, it's only that the operational part what we do, and the advices comes from the people like you or the tax advisors or the law advisors for the corporate. So we come into play for only the implementation part and not on the advisory part. So as I was saying, so we work in 5 verticals. One is the global entity management services, where we incorporate entities in different jurisdictions for our client. Then one is the other is the globalization services, which covers the various services like the external CFO services, management services, accounting services, where people would not like to have their own CFO over there, and they would like to, or the accounts team, not the CFO, or the accounts team in their foreign jurisdictions, and they take our services for that. So we come into play for that in those services. Then the fund administration. This is one of our prime vertical where we are listed on the London Stock of Exchange, where we incorporate funds for the large funds globally in different jurisdictions, right from Luxembourg to Cayman to Mauritius to Singapore, where normally the fund domiciliation happens. And we administer the fund right from the, taking the licenses, licensing with the licensing with the authorities, and NAV calculation, onboarding of the clients. So this is what primarily we do for the fund services. So we don't call the shots on the advisory part or on the investment side. It's only purely fiduciary services what we do in the fund services. And then we also have our own bank. So in today, the biggest challenge which comes into, like, you can incorporate an entity in Netherlands, you can incorporate an entity in Singapore, but it takes ages to have a bank account. And when the client have an urgent transaction or the acquisitions to do, it takes hell of a time. So because we have done our own compliances and the checks on the client before onboarding it on, before incorporating the entity, so that's the first thing, like we would like to associate with the clients in terms of offering these banking services to them, where they can start their operations with our bank, and then we can always have a local substance, be it Singapore or be it Netherlands, where it takes about 3 to 4 months time to initiate the bank processes. Then we have financial market services, which covers, different capital markets and the other stuff for our global clients where they want escrow services, where they want securitization services. So that is one of our expertise, which we associate with our clients globally for this. So most of us globally, like we are 1,000+ strengths globally. So most of us are either the tax accountants or the chartered or the lawyers who understand cross-border taxation well. Though again, I'm reiterating that we don't advise to our clients. It's only that, it is the advice which comes from people like you, and then we implement the structures. I think this is the least forum which I have ever seen before presenting. I think there are hardly few people left in the anyway. So primarily, I would say I will just wrap it up. So it is like, whenever there is like whatever we have been discussing, it's always been interacting. We face a lot of music when the shit hits the roof in terms of the GAR, in terms of the existence of the company, in terms of the substance, because we are the directors, we sign the documents, but we always always been advising our clients, always been asking our clients to put this substance. Today morning, I would give you the live example, like we have expanded the BVI office because they have come out with a very strong, very strong norm of the economic substance. Now there won't be, I don't think so, okay, going forward, there can be a conduit or a shell company as a holdco or as an operating company, which used to be earlier days. Now even the BVI authorities wants a substance from the client side, cannot be from the fiduciary side. So this is like, and we have been asking, so our clients, most of we handle even the sovereign companies of Government of India and XYZ as well from various, they have started putting substance. It's not that, you can operate sitting from here and taking the decision, call this out sitting off here and do your business. I think gone other days. So, and from the compliance perspective, we are very compliant. We do things as per the compliance of that, jurisdictions where the company is domiciled for the client. Because there is, in few jurisdictions, there is a criminal liability on the director as well, where he has signed the document in the capacity of a fiduciary director as well. So our global clients are multinational companies, listed, non-listed, private equities, large venture capital funds, hedge funds, even the sovereign companies are with us from different governments. Private and corporate banks are our clients, single and multinational, family offices, because of the sub-fund culture and of the fund culture and of the trust culture, so family offices is our clients. So I would like to end here, but I would reiterate that, so I think we are one of the most pioneer first companies, I would say, not the pioneer, who started implementing and educated on the FATCA, on the GAR, on the BEPS, on the POEM for our clients. Okay, we started rejecting the clients. I think last year also we rejected about 3,000 entities, or we offloaded 3,000 entities of our client globally because they were not compliant and they were not, agreeing what the local jurisdictions was asking for. So in terms of the compliances, we are very, very, very strict, and I think our rejection rate is more than the acceptance rate globally. Thank you. If you have any questions, anything, I think my colleagues are here since morning. So if you have anything, we are free to, get associated and address all those queries. Thank you.
Thank you, Mr. Vajpayee. Ladies and gentlemen, we come to a close for today's sessions. And it's been very informative, very interactive, and very communicative. So thank you, each one of you, and all the speakers and all the panelists. Of course, dinner is going to be at 7 p.m. There's going to be cocktails and drinks at Catherine. And of course, veg food at Dynasty. So do enjoy yourselves, and see you tomorrow. Good night. This is Jackie signing out.